there was a policy review in October. But before that, I wanted to capture a soundbite which I had read somewhere in the newspaper that, good regulations are not about more rules, but better rules. And I think that's where we are headed towards. The October policy review, which happened, there was a slew of new regulations which came in purely from the perspective of building resiliency, strengthening our financial system. In that spirit, we are moving ahead and capturing some of those regulations. And more importantly, also trying to get a more global view. I have with me my co-speaker, Martim. He comes with decades of experience in global risk management. And we'll try to get some of the global views as well as look at more closely what has really happened. So it's kind of a recap of whatever has been happening in the regulation environment in India. So regulatory focus, global regulators and RBI. So I'll invite Martim to share his views on what's really happening globally and how it ties up with what's happening in India. So there's a theme to it. There's an undercurrent which is more global. So Martim, would request you to share your views on this.
Well, first of all, it's a pleasure to be here talking with the audience. I'll try to be brief. I know that we are the last ones on stage, and that probably you would like to enjoy a little bit of the cocktails and some of the food. So I'll try to be brief as possible. I mean, it's no secret for everyone that regulations have been around the block. I mean, nowadays, for everything that we do, a regulation will follow. And if you are in the banking industry, that is even more true, right? So obviously, we have regulations around the liquidity, and a lot of this was coming from the aftermath of some of the crises. It was already mentioned, the changes that we have now on the interest rate risk regulation. I mean, fundamentally, regulations have been trying to be more quantitative. There's a mixed trend on the regulations in terms of being less prescriptive, but still clear in terms of the guidelines. So a lot of the regulations have been improved to incorporate lessons learned, but also trying to provide guidelines for banks on how to follow the regulation and how to quantify the risks. Some of these regulations have been around for already some time, and as mentioned, some of these regulations have been now revised, and banks have been, let's say, looking at those revisions. So one of the things that is currently happening in Europe, for example, is the IRRBB models for under the Basel. They have been revised, and banks. The regulator have been calling some of the banks and saying, "Well, your models are outdated. Probably you need to revise those models." So there's been a movement to actually improve the quality of the models. Similar to that, the IFRS 9, especially during the pandemic, was let's say an abuse of use of the post-model adjustments. At that point in time, during the pandemic, regulators were a little bit more benevolent. But now that we are out of that period, again, regulators are coming back to banks and say, well, this is a model-based regulation. So if you are doing too much of the adjustments, it means that the model is not doing nothing. So you have to, in one side, prove me why you are making the adjustment, and the other side probably need to look back to the models and say, are these the right models I have in place? So, I mean, it's a bit of a trend. And obviously, another aspect that regulators have been looking at, and actually some of the banks have been fined regarding that, is in the process. Okay, the number is good. You have the model. You provide me the number. That's all fine. But I'm not so sure about your process that you went through to actually collect the data, calculate the numbers, and provide me them. So maybe we should look at the process and make sure that the processes in place are properly controlled and properly automated. So these are just quickly on the general comments on what I've been talking with regulators and some of the banks around the world. And of course, I mean, India is also following the same. I see a trend in India to more and more improve the regulations and actually again follow the trend globally. Sudhanshu, you want to do some additional?
Sure. Thanks, Martin. So in line with what is happening globally, we have had, like I mentioned in my initial thoughts, a slew of regulations have come up. The Basel III regulations is one of the key ones. More granularization, stronger adoption of some of the standardized approaches. So that's what is happening on the regulatory and capital side. There's also IRRBB, although the guidelines have existed since February, I think, of 2023. However, there is a stronger adoption of this, which may be expected in the future. Again, because we are trying to align with what is happening and what is also driven as part of the Basel mandate. IFRS 9, I think Jitesh in the last session covered it very well in terms of how the adoption of these accounting principles is happening. AI and data quality, again, one of the strong areas which we have discussed today. So in all, if I have to tie it in a neat little ribbon, these are the key areas we wanted to cover today, and which is essentially the regulatory theme in India. Apart from that, there is also the climate, ESG, and transition risk, which has been running in India as a theme for a very long time. Although the adoption globally has, sort of tapered a little bit, but this is something which we should expect in the future. This is broadly what we think is the regulatory focus in India now and in the future, and it would somehow align with what is happening globally. We look at two regulations very closely, Ind AS 109, and I'm bringing up Ind AS 109 again. And one of the major reasons for that is Martim's presence in today's session. He's one of the pioneers for developing the IFRS 9 solution at SAS. I think it's more than a decade ago when he developed the IFRS 9 solutions. IFRS 9 was to be adopted globally around in January of 2018. We already had at SAS close to 80 odd banks, which were the initial adopters of IFRS 9. And Martim had pioneered that entire sort of development in SAS. So we would love to hear his opinions on IFRS 9 and by induction on Ind AS 109. So Martim, over to you. Please do share your thoughts on IFRS 9.
Sure. Thank you. Well, like as you can see from the slide, I mean, the adoption of the solution worldwide is quite holistic. I mean, we in pretty much in all the different countries and different continents where IFRS 9 was implemented, we had a chance to help banks to support the process. And it was quite an interesting journey, quite a learning process, because obviously when IFRS 9 guidelines were published, no one actually had a clear picture of what to do. And if you remember, when IFRS 9 was published, the mandate is that the whole world should adopt IFRS 9 at the same day, at the same time, right? And obviously it's a big challenge because what typically happens in regulations and in many of the other stories around the world in the past is that there are a couple of countries that adopt first, and then a couple of countries that will actually use the lessons learned to adopt, and somehow there is a sort of cascading effect in terms of how to let's say implement those regulations or those specific systems. So this one was particularly interesting because I was talking with banks in Malaysia one week, and then talking with banks in UK the week after, and obviously the questions were still quite similar. And it was for me. So when Sudhanshu say that I have created, I was fundamentally the one carrying the message. So whatever I learned in UK, I was sharing in Malaysia. Whatever I learned in Malaysia, I was sharing in Colombia, and so on and so forth. So it was a very collaborative approach because, as I pointed out, no one knew exactly what to do and how to do. So we evolved the solution in line with what our discussions with customers and understand how customers will actually see the solution being used efficiently.
Thanks, Martim.
Going a little bit more on the details, and again, as I said, fundamentally a very collaborative process. It was clear from the beginning that obviously the models were key, but the models without the data, they would never fly. So fundamentally, the first question was, do I have the right data? And a lot of the banks were not ready with that data. A lot of the banks had to revisit the systems to be sure that they would be collecting the right data, so that they could feed the models with the right data and actually have the models working properly. So in that sense, the first step of the solution is actually to capture that data, to organize that data, to prepare that data, so it actually feeds the model properly. And one of key aspects is that data doesn't come perfect 100% of the times. I mean, it's never fully perfect. So one of the key aspects that we learn quickly is that at the beginning, we should have a few checks to understand if the data is in proper shape, and apply some mitigation actions in case, so that when the model executes, it actually performs accordingly. There are two things were clear here. I mean, if you feed the model with the wrong data, obviously you get the wrong results. That's clear. And if you wait for the model to execute to then understand if the data was right, then you would just be losing too much time. So in that sense, it was important to have a step in the process that make sure the data is the right one in order to feed the model. And fundamentally, in what are the parameters of the model? So if the model is using rating, then we need to be sure that rating is properly filled in. Then we have the calculation. The calculation comes from a different piece of the story. So as mentioned before, obviously you need the PD models and LGD models, and you need to actually to develop those models, calibrate, etc. That's one key aspect. But because the calculation itself also depends on cash flows, then the question was, do I have those cash flows ready? Now, if you go to an European bank or an American bank with very mature and very stable ALM systems, that was not a problem for them. All of them have cash flows they can feed into the solution. But if you go in some of the other regions of the globe, maybe the ALM systems are not as mature, and fundamentally maybe those cash flows don't capture the necessary nuances so that it can feed the ECL calculation. So making sure that you have behavioral cash flows and all that was key in order to understand and feed the calculation correctly. So again, we created that optionality in the solution so that you can actually generate a cash flow solution or import the cash flows depending on your particular situation in the bank. Now, obviously, the next step was the reporting engine and preparing the postings to the accounting system. That was obviously clear, comparing the numbers with the numbers of the previous period to understand if there was too much fluctuation or not. Obviously, banks want to understand, to anticipate what would be the change. As you know, in general, the execution is done quarterly, because it's quarterly that you actually publish the numbers. But most of the banks actually execute it monthly so that they can, let's say, understand the trend, and they are not waiting for the quarter so to be surprised with the numbers. All of this should come obviously under a workflow, because these are steps that are happening. Sometimes you execute, then you have to go back and execute again. So in that sense, obviously you should have a workflow engine to support it. And also because you have the step to execute the models, and then you have the step to do the adjustments and calibrate the numbers. So in that sense, and a workflow engine was clear in terms of being needed to support the process. Obviously, the whole process needs to be auditable and transparent. Banks not only need it for their own control of the process, making sure that the numbers that they are moving into the accounting system, we should not forget that IFRS 9 affects directly the bottom line. So obviously you want to understand how and why the number is what it is, right? So understanding that number came from that model, and that model used that data was key to get that traceability. And finally, and as already mentioned today for many times, the appropriate models need to be governed, need to be tested, need to understand if the model is still valid or it needs to be recalibrated. So obviously you have to have what was already discussed here thoroughly, that needs to have the model risk management in place to actually have that guarantee that the models are properly used and properly governed. So very quickly, but as I was saying before, the solution ended up being the unification of all the feedbacks and all the interactions I had with banks all around the world that somehow helped me creating the best solution to support the process.
So with those thoughts from Martim, what we do realize is, and of course, based on global experience as well, there's a significant amount of time we need to give for our IFRS 9 systems to become stable, have data pipelines which provide you with more recent data. It's not that you're building models with data which is lagged up to, let's say, 1 month or 2 months. You need to have models which are testable, flexible, and also easily adoptable as and when required as part of your testing and validation guidelines. We are expected to adopt this IFRS 9 by 2027 March. Having said that, we are already at the end of 2025. Even if we consider a 1-year parallel run, I think waiting is definitely not an option for any of us. Moving forward, just highlighting the end-to-end IFRS 9 capabilities and acceleration that is provided by the SaaS system, and where we can help with quick adoption based on the maturity of each organization, is we have a complete solution which goes from data to posting your accounting entries, which includes some features which are desirable also given recent regulations. So we also have a complete cash flow generation, as Martin pointed out, which enables our EIR computation. We also have an attribution analysis engine, which allows us to track our SICR more effectively as we go forward, brings more stability into the system. And of course, there's a closely coupled GL and journal entry posting which we provide, which is seamlessly connected with your final GLs. So that accelerates your IFRS 9 journey. Again, because we are already at the end of 2025, it's imperative that we have a framework which is end-to-end. Why is it a strategic imperative? Beyond just implementing IFRS 9, how do we move forward once your IFRS 9 implementation is completed or is in some phase of implementation? Martin, would like to hear your thoughts on what's beyond IFRS 9 implementation and how we can utilize it more strategically as we move forward.
I mean, IFRS 9 at the end of the day is the expectation on your credit losses. So in that sense, can be used across the business in different aspects. One obvious aspect is that when you are simulating your business or when you are doing balance sheet projections to understand how your business will evolve, either because you are doing planning or either because you are doing a stress test exercise to understand the resilience of the business, obviously provisions is a key element of that exercise. So again, typically the system allows you to be used, not specifically and only for the current ECL, but also to support simulated ECL in support of, again, credit losses analysis or more broadly, the balance sheet management analysis. That's clear. But also from a general perspective, you are putting in place a full framework that will help you understand better what is your positions and how you can actually understand how the resilience of your business is standing. So in that sense, again, understanding the way you work across the different aspects and improving. Because one of the things that maybe not so much in India nowadays, because there's a lot of evolution in India already. But I remember when IFRS 9 started in 2018, a lot of the banks around the world, again, had a very weak modeling capability. So IFRS 9 was one of the, let's say, the excuses or the engines to actually create the culture in a lot of the banks around the world about looking at the risk management in more quantifiable way and in a more rigorous way. I mean, a lot of those banks were using standard approach for Basel capital. So that culture of having the ability and the structure and the people to actually create models, analyze credit risk in detail, so on and so forth, was something that came as a sort of a secondary value of implementing IFRS 9.
Sure. I think with that, we can conclude this session of ours. We hope you had a good time. We hope you liked the experiences which we have shared. I'd like to thank Martin for bringing in a global view. If there are any questions, we'd love to talk to you over dinner. Thank you.